Welcome back to the third part of this topic. Now we are going to discuss the third learning objective, which is to understand accounting issues related to acquiring and valuing plant assets, or PPE. Now let's talk about the valuations of property, plant, and equipment. Proper valuations ensures that the financial statements reflects an accurate cost for assets a company uses in its operations. When a company acquires property, plant, and equipment, it must record the asset at fair value. But here we have two different ways to determine fair value. It, uh, the company should use whichever is more clearly evident. Okay, so will depend on the situations. In some cases, it is easier to determine the fair value of what the company is giving up, the first point here, in exchange for the asset. For example, if a company pays cash or transfers other asset to acquire new equipment, we use the fair value of what the company gave up. In other situations, it is clearer to use the fair value of the assets that are being received. If it is the case, the company is acquiring a new asset in a barter transactions or in exchange for something other than cash. Ultimately, the key is to record the asset based on the more clearly evident fair value, whether that's the value of what's given up or the value of what is received. This approach ensures that the financial statements reflects the most accurate valuations of the company asset. Okay, when it comes to valuing property, plant, and equipment, there are several specific situations where the methods of valuations might vary. Let's walk through some of the common approaches used. The first one here is cash discount. If a company receives a cash discount for prompt payment when purchasing an asset, the asset is recorded as the discounted price, not the full or the purchase price of the asset. So we need to consider the discounts given by the the seller. Next, for the asset purchase on long-term credit contract, number 2 here, the valuation is based on the present value of the considerations exchanged. So, even though the company may pay over time, the asset is recorded as its present value at the time of acquisitions. And here, if you can still recall the concept of time value of money, here we applied that concept. Hope you still remember your topic from last semester. Move on to the situations where the company probably buys several assets together in a lump sum purchase. That means that the company purchase several assets with one price. The total costs will be allocated among the individual assets based on their relative fair value, fair market value. And this ensures each asset is properly valued in proportion to its actual worth. So we need to determine fair value of each asset, and we will spread or allocate the total price in proportion to their fair value. Lastly, here if the company acquires an asset by issuing its own shares, the market price of the shares is used to determine the asset's value. This is because the market price is considered as a reliable indicator of the fair value. So it indicates the market price of the the shares indicates the fair value of the asset that is exchanged. This method ensures that the value of PPE in our balance sheet reflects the actual economic exchange that took place, whether the payment is immediate, deferred, or made with shares. All right, let's talk about how companies handle the exchange of non-monetary assets. Typically, these exchanges are accounted for based on their fair value. Okay, now this fair value could be could be the fair value of the asset given up, or the fair value of the asset received, whichever is clearly more evident from our explanations before. Now, one important point to remember is that any gains or losses that occur from this exchange are recognized immediately in the company's financial statements. So what we are going to do here is we are going to see what would be the accounting treatment if the company exchanges its non-monetary asset. Okay, and from this exchange, the company will either generate gain or have gain or incur loss from the exchange. This is the key conditions here. When the transactions has what's called commercial substance, okay, so the company should recognize immediately any gains or losses on the exchange when the transactions has commercial substance. In simple terms, commercial substance means that the exchange is expected to change the future cash flow of the business in a significant way. So, if the exchange brings about a meaningful financial impact, then any gains or losses are accounted for right away. Okay, so now we are going to look at what happens when a company exchanges one non-monetary asset for another, ends up with loss. So we have loss situation here. Here is the key point. If a company takes a loss in this exchange, they need to recognize that loss right away. It doesn't matter if the exchange has commercial substance, meaning whether it affects the company's future cash flow or not, the company still need to record the loss immediately. Okay, now why is that? It is pretty simple. If a company waited to record the loss, it would make the value of the asset look higher than it really is. So, by recording the loss immediately, we make sure that asset is shown at its correct value, the amount you could actually get for it if you sold it for cash. And this prevents a company from overstating or inflating the value of the asset. Let's walk through an example to give a clear explanations. So we have Information Processing Incorporations, a company that trades its old machine for a new one at Jared Business Solutions Incorporations. Now, this exchange has what's called commercial substance, which just means that it affects future cash flows of information processing. Here's the background of these illustrations. The old machine originally cost 12,000, but after accounting for the accumulated depreciations of 4,000, the book value is now 8,000. The fair value of the old machine, meaning what it's worth on the market, okay, which is 6,000 here. Now the new machine has a list price of 16,000, and in this case, Jared, the company selling the new machine, offers information processing a trade-in allowance of 9,000 for their old machine. which is a bit more than its fair value. The fair value is we have 6,000, but here the Jared trade-in allowance for 9,000, higher than its fair value. This leaves information processing with a balance of 7,000 cash they need to pay to the Jared. Okay, so this example simple is the exchange of old machine with new one. Okay, you have the information here. Okay, we have calculation here. I almost missed. To figure out the cost of the new machine, because from this we have several informations here, and we need to calculate the cost of the new machine. We need to combine two things: the cash paid of 7,000 and the fair value of the old machine they trade in, which is the 6,000. And together we the total cost of the new machine is 13,000. Okay, notice that we use the fair value of the old machine, which is 9,000, which is 6,000, not the book value, not the 8,000, to determine the cost of the new machine. That's because the fair value reflects what is actually worth today, the 6,000, not the 8,000. Now that we have gone through the trade-in process, let's see how information processing records this transaction in their books. First, we know that the cost of new equipment is 13,000, which we already calculated. So we record that as an increase in equipment. So that's why we have equipment in debit side here. Next we have accumulated a depreciation for the old machine, which is 4,000. We need to remove it from the book, so we debit it. And okay, one important thing here, that the company records a loss on disposal of equipment. How do we got that number? It is the difference between the fair value of the old asset. The fair value of the old machine is 6,000 and the book value is 8,000. That's how we calculate the loss. So it is book value minus fair value, 8,000 minus 6,000, which gives us 2,000 loss on disposal of the equipment. Now we also need to show that the company got rid or disposed of the old equipment, which was originally worth 12,000. So we remove the amount from equipment. That's why we credit equipment, and this refers to the old equipment of 12,000. And lastly, we have a cash payment of 7,000, which is the amount of information processing paid to cover the difference after the trade-in. Okay, that's why we have cash in the credit side of 7,000. Okay, we change a bit here into gain situations. If the exchange has commercial substance, meaning it impacts the company's future cash flows, the company will usually record the new asset they have acquired at the very value of the asset they gave up. In other words, they record the cost of the new asset based on what the old one was worth on the market at the time of the trade. And here's the important part. Okay, when the fair value of the asset given up is higher than its book value, the company recognizes a gain immediately. Okay. Now let's look at an example of how a company records a gain when exchanging non-monetary asset. This example states that the interstate transportation company is trading its old truck for a semi-truck. The book value of its used old truck is 42,000, coming from 64,000 cost less 22,000 accumulated depreciations. The value of this old truck is 49,000, higher than its book value of 42,000. And the exchange requires interstate to pay 11,000 cash, and thus we can calculate the cost of new semi-truck here. Okay, as from this calculation, we have the cost of new semi-truck of 60,000 by adding up the fair value of the all trucks and the cash paid by the interstate transportations. Okay, let's take a look how interstate records these exchange transactions where they dispose of their used or old truck and recognize again. First, they record the new semi-truck at 60,000, obviously, which is the cost of the new truck they are requiring from our previous calculations. So we need to debit truck of 60,000, and next we have accumulated depreciations of the old truck of 20,000. We need to remove it from our balance sheet. Now we need to remove or dispose of the truck, the old one, from our records with its original cost of 64,000. Now, here where the gain comes in. The fair value of the used truck is 49,000, but the book value is 42,000. So here the interstate recognizes a 7,000 gain on the disposal of this truck. Where does it come from? It is from the book value or the fair value of the used truck minus the book value. 49,000 minus 42,000. And finally, of course, we see the interstate pays 11,000 in cash to complete the transactions. So in summary, we debit the new semi-truck, remove the old trucks and accumulated depreciations, record the gain on disposal and account for the cash payment. All right. In the next sections, we will discuss learning objective 4 along with learning objective 5, which are costs subsequent to acquisition of PPE and accounting treatment for dispositions. We a bit touch the dispositions in our explanations here, but we need to explore more in the next sections.